Welcome to Momentum Monday. Today is October 2nd, 2022. Howard, you're finally back.
I am home. The markets can begin the bottoming process.
Yeah, they can. I mean, actually,
Or they could crash.
so I used to have like shoes with the name Nobull, like Nobull, Nobull.
Yeah, Instagram. They're like an Instagram brand.
Yeah, and yesterday someone stole those shoes from me, so there's gotta be a bottoming signal.
I really learned a lot on my month away. People were very respectful of the work. You let me take a week off. We didn't really miss much. I think if we had done a show last week, we would have said, get the fuck out of the market. And I think, or you probably were short last week, I imagine.
I didn't do much. I was mostly in cash. Like I was watching mostly.
All right, so catch us up. I am completely, I will summarize my feelings by saying the narrative for the first time that I can imagine is worse than the sentiment. Usually the sentiment gets bad. In March of 2020, the world was ending. The media wasn't so much focused on stocks. Stocks were crashing, but there was other problems. This time it feels like everybody's watching the market, so the narrative is super negative, but I don't feel like people are selling. Apple's still double where it was. I just don't feel people have given us that give up moment. So tell me how you feel about things here.
I mean, the S&P made new year-to-date lows last week. It finally tested its summer lows. It went below them. It closed below them.
And a lot of distribution the last week too.
A lot of distribution. Look at those big red volume bars.
Yeah.
So definitely there's some professional selling, probably forced liquidations. There's a rumor circling around that pension funds have gotten into
they're not rumors.
Carry trades on the wrong side of carry trades.
These are real things peeking their head. Remember, pension funds, I'm going to explain something. Pension funds, in hindsight, it's obvious. Banks figure out ways to blow things up. They have been creating products for pension funds to bet on rates staying low because there was negative interest rates, right? And now, as no one could expect, and this is what markets do, rates haven't just gone up, they've exploded to the upside. So these pension funds are getting huge capital calls on these derivatives that they created around having low interest rates, okay? So this is not possibly a problem. The only question is how big the problem is. So this is the stuff that's headed to page one that isn't quite on page one, that will create, good or bad, the sentiment that we need to create some sort of bottom. This has to do with Credit Suisse. This has to do with the other banks, JP Morgan, Deutsche Bank, all the banks that have been somehow around the world creating derivatives for pension funds in a low yield environment. This full stop. And it's just breaking news last week. So what I worry about are the people hiding out in these triple leveraged ETFs. Same thing. It's not so much about the NASDAQ 100. It's about how many people are hiding out in TQQQ and ROM, these leveraged products that volume's accelerating, but the VIX is only 30. And if the VIX gets above 40 here, these things could shut down, and especially with Credit Suisse ready to go out of business.
Anything is possible, and definitely the things that are going to break this market will be different than the ones that broke it last time. It's always the same story. It's always a different reason. But as you said, there's definitely some professional forced selling going on. And when that's happening, it's really hard to pick up stocks, no matter how discounted you might think they are. It has gotten to a situation where the Fed might start worrying more about financial stability than about inflation. As you know, after the close on Friday, they announced that there will be an emergency FOMC meeting on Monday.
It did not. I've been traveling, so that's interesting.
Yeah, so I mean that they're not having another meeting to raise interest rates, surprisingly.
I mean, again, it's too obvious to say how bad they've been. I don't want to waste an hour. Everybody's now a Fed and macro expert. I'm just a price watcher, and I'm horrified by how clueless anybody that watches prices forget. That is the data that matters. Prices,
Yeah.
that summarizes everything that's going on in markets. I don't understand how you could continually raise rates. Again, maybe we needed to, but at the pace that they've done it, when no one has had time to digest what it's going to mean. We're at a complete standstill in real estate markets. We're at a complete standstill in the bond markets. And wow, what is that? That's the real estate?
Yeah, this is the REITs ETF. It
So
is
that's like
supposed to be
down
stable.
40%. Yeah. It's in free fall.
Yeah, of course. I mean, when you have treasuries yielding 4%, of course, anything high dividend is going to fall, and especially connected to real estate. So it's
okay. Well, that's on my list. IYR then
both,
on my list. XLU and IYR are on my list. If they both see in the 60s this week, I mean, I'm not going to be buying Apple. I'm going to be buying utilities and real estate indexes. These are crash scenarios already. So if they have a whoosh down, wow. I mean, I don't know what the Fed was thinking they were going to happen. I haven't really looked beyond tech stocks, which seem to just be in slow meltdown. They don't seem to be in this type of meltdown.
I mean, it depends. Like Apple wasn't really that slow. As it's everyone's staple stock.
Why can't
right?
this be an $80 stock on a bad
It
whoosh?
could be. It could be 100. Yeah, definitely.
And that's about where I would be. That'd be my first instinct.
Let me
in the 80s.
Okay.
Nowhere near a buy here.
Yeah. I mean, at this point, correlations are so high that when they bottom, they're going to bottom together. Yeah. So they're going to bounce together. So when that happens, like I rather own something that is high beta, is going to deliver better results than something like XLU, which is low beta. But that's just me. It just depends on your time horizon.
Good point.
So last week, we heard that Bank of England had to step up and buy their treasuries, like English treasuries, because the interest rates were going super.
Buying them, Ivan, at the same time they're about to raise 1.5 points. So it's like fake news in that makes no sense. If you're going to raise rates, don't step in to save the market. Like I don't get it. Like,
well, they had to save some of their financial institutions, and it seems all of that interest rates raising is going to lead to a point where central banks around the world will have to step up and start buying treasuries again. So there'll be another round of QE at some point, maybe next year, maybe earlier. So
yeah, but people have hindsight bias. I don't think what people understand this time around. I mean, sorry, I hope I'm wrong. Let's just full stop. Like I'm 57. I don't have to luckily find a market bottom to survive. Okay. But this is what we do. Okay. The difference this time is that people have been hit over the head on the buy. This is the first time since 2008 that people have been hit over the head with buy the dip, at least in tech. Okay. There is recency bias here. People won't be as quick to and if they do step into buy, there'll be a lot of flipping going on. So it's gonna take some real fundamental news to turn this around right now. This isn't about the Fed's flipping. And this is really about how poorly run these central agencies are. And really, they may be doing crypto the biggest favor here. Like, it's not like crypto's a buy here, but like if you ever wanted to create a story for decentralized money, you're creating it. I think relative to everything else, Bitcoin's probably doing great the last month.
Yeah, definitely. The past week and a half, definitely stabilizing. Typically when the QQQ has been weak, Bitcoin has been weaker, but not in the last week or so. So it seems like if this is the future path, and it seems to be that there'll be more QE coming up, probably gold and Bitcoin are the ones to benefit.
That's what I'm talking to my managers that we've allocated to in crypto, and and there's an obvious relative strength. Again, it's very short-term relative strength that we're finally seeing here in crypto. It's not like I'm rushing out to add more long-term exposure to crypto, but we're at some point of breaking point. It doesn't matter now how many emergency meetings we have. The unintended consequences of rates going from 0 to 4, 1-year T-bills going from 0 to 4, are set in motion, right? Just like COVID set off things in motion. And now it's up to us, you and me, and investors to think through what will come out of this as growth. Obviously, nuclear, I keep talking about, obviously climate type things. Is there anything that you're seeing showing relative strength?
I mean, the one sector is really standing out is biotech. I mean, obviously the sector as a whole is still in a downtrend. Yeah. But just compare it to the S&P, which just closed at new year-to-date lows. It's just pretty far from its year-to-date lows, and we're starting to
just 30% above lows. Got it.
Okay. Some individual stocks in biotech, they're just showing up on the 52-week high list. I mean, obviously, if there's more forced liquidation, those stocks are going to get hit. But overall, like the basis, technically, what we're seeing, they're mostly
for treatment of cancer. Okay, so cancer,
they're in biotech. So definitely there've been some amazing discoveries in the sector, and those stocks have been accumulated compared to others.
Okay, so hang on. This is going to put up. This is inflammatory bowel, which is a huge problem, not just because of the markets. Hang on. So this is RXDX. Okay, sorry, that is incredible. So it went public last year. People want to own this. Okay, so there you go. So now
there are quite a few of them. It's not just one or two.
Hellas, AP. Will you share these, Ivan, in your note?
Sure. Yeah, of course. I'll mention some of them.
Yeah. What is the symbol on this one?
APLS, like apples, but with S. Okay. Yeah.
And this does inflammatory diseases. Got it. Okay.
I mean, there's so many of them, as I said. It's just.
Okay, well, there you go. We know where the money's going to flow. People, just goes. Yeah. This is tech meets life, meets quality of life. So there is going to be a bull market, and it's going to be around alternative energy, climate, and. No, it's so interesting, Ivan, and I hate saying the word climate because it immediately, but I was with, I'm going to have him on my podcast. I was with a really smart kid, Dave Finocchio. And Dave, of all things, he's a savant. He's in his early 40s. He started Bleacher Report. I don't know if you follow sports sites, Ivan, but maybe 15 years ago, he started Bleacher Report, which was one of the very first. He was in college when he started, and he enlisted kids. You can't do this anymore as interns to write content around like long tail sports things. Anyways, it got bought by Turner, and he's started a new thing right now around climate, aimed at not at inflammatory like headlines, but it's called oh my goodness. But he's taking the same excitement that he had around like long tail sports and applying it to common. It's called The Last. And so he's not writing these freaky headlines. He's trying to appeal to both sides by saying, climate affects fishing, climate affects kayaking, climate affects skiing, and to really build up communities around really what matters is like, hey man, like we could argue about left, right, whatever, but it's time to start talking about all the real things that are happening with climate, less snow, more volatile rivers, the things that both sides, things that both sides do that are affected by climate. So some of the smartest, it's not just about changing the climate, it's about, conversation and community. So I don't think it's as simple as investing in a clean energy ETF that you're showing here, Ivan. I think this is really such a unique time in both building community, content, media, because every article I've read about, honestly, from the Atlantic to Fox, is it's either the headline is storm because of climate change, or like it's so polarizing. But anyways, the biotech stuff that you just showed is fascinating. You've been talking about this for 2-3 months. This is all about the
I mean,
relevance.
it's their turn. If you remember, after there was a pretty big correction in 2011, 2010, 2011, when the market didn't really go anywhere for like a year and a half, and small caps thing went down 30, 40%. And out of that correction, the biotech was the new star. And then from 2011 to 2013, 14, let's look at this trend here. Biotech was the leading stock for a few years. So there was a lot of biotech stocks went up like 500 to 1,000% during
And
that.
really, all they've done is digest it now for 5-6 years, right? So they,
or yeah, you're right. I mean, basically 6-7 years of sideways.
So really, yeah. So really, that trend has been digested. That parabolic move really only led to a 30-40% pullback. If we're lucky, that's what will happen with the Nasdaq. A couple of things we know in looking at the Qs is that the game is rigged, right? The Fed is politicized. I've been saying that for a while. I apologize. People that have been on my podcast have talked about this. But the one good news is this is rigged. At some point, they will cut rates because debt is being paid in US dollars. And again, like, I don't know. Obviously, bad policy can be stacked on top of bad policy. So there's always that like outlier event that you can't just blindly buy the dip. But we're getting to the point where you seasonally too, where there should be a good rally. I want to be more positive like I was in March 2020 when it was just screaming panic and brands were being on sale. But like, I don't see it this time. Look at McDonald's. They're just breaking down.
Yeah, right? McDonald's, Nike is down what, like 55%.
Yeah. Insane. Well, McDonald's is just breaking down. Nike, we're back at 2015 prices. So at some point in the next 90 days, I can see myself adding Nike back to my portfolio. It's not going anymore. But it was quite obvious to me when I sold it in the low 100s that these things, when I got rid of McDonald's, it's like, don't see how we don't have a spike down here. They can't just continue to be the only ones that survive. But
they should benefit during recession, though.
They should benefit, but to a point, and they have benefit. They haven't gone down, and they're stealing market share, no doubt. But the valuation is still unbelievably high for McDonald's, and it's been a perfect.
And this is true for most
companies. They should be affected by real estate too, Ivan. They're going to be affected by real estate.
Yeah, exactly. What you say about valuation is really true for many companies, even for Nike, because yes, they're down 50-55%, but valuation-wise, they're still trading at a pretty hefty multiple. And we know that in bear markets, multiples contract, they go down, especially if we have a prolonged bear market where people can kind of depressed. We may see those PE ratios halved from here. So even if a company's earnings didn't really go down or even go up,
this can be a $40 stock just based on PE. That's what people have to understand. Yes, these initial 50% move down are based on a change in narrative. The next 50% down could just be based on fact of fundamentals and interest rates.
Absolutely. Sentiment, basically, yeah.
And true fundamentals, which is, hey, it should trade at a 15 PE, and it can overshoot to a 10 PE if we really are in a prolonged bear market. Again, hopefully this is the bottom, but it doesn't feel like stocks like Nike are just going to bounce back like they did in 2020 because the world is definitely a different place. The travel stocks still a mess, right? Like if we look at like Carnival,
they're just getting destroyed. Yeah, look at this.
They huff and they puff and they can't.
I don't know where the all-time high, all-time low.
Yeah,
basically.
Yeah, these are zeros in my opinion. Where's the
booking?
Just breaking down potentially.
Yeah.
Where's the Indian one, MMYT? That was holding up very well. No.
Yeah, it's not that bad actually. I mean, compared to this is a monthly, so let's look at weekly. So
yeah. So again, there is some strength out there. India, I think, would be a place that's not on my interest radar. I just don't have enough knowledge.
Okay, let's see.
It looks like you're right about biotech. Is there anything besides biotech that's showing any relative strength? I think the transportations have rolled over.
That's it. Biotech is the main one that is standing out in terms of relative strength. Really, this is the one. Even climate change stocks have started to mean, not really break down, but really pull back to their 200-day moving average. And I can definitely see them at some point try. I mean, First Solar is definitely the leader. Look at it just going sideways while the market is getting absolutely crushed. So, and still getting accumulated. So this is definitely one of the future leaders. I don't know why. It seems like it's just a generic product, what they're offering, but price-wise, is definitely probably one of the strongest stocks currently in the market. By just being able to hold.
I saw one of my old favorites, Taser, is kind of going sideways. Axon, it's holding its low.
Okay.
But again, still, there's no reason to buy these. But again, way off its lows. So again, we got to own relative strength here if you're going to add new money. I do feel like some of these past leaders that I own, I'm not selling them here down 50% anymore because I want some market exposure, but the world has definitely changed. I think Amazon, you can see it's probably going to break.
I mean, Druckenmiller is saying that, in a bad case scenario, we might have like a sideways market for 10, 15 years. And I was going to pull up, let's say, Dow Jones Composite. Let's see.
Which means the market cap, the leaders, it means like the big companies would go sideways, right? I think small caps would probably.
I mean, there were some, quite a few rallies during that time that he's referring to, that sideways era from 65 to 82. During that, high inflationary period, high interest rates, low growth. There were quite a few rallies. This is the monthly chart. And declines, but for a passive investor, it was like 15 years of nothing and then high inflation. So at the end of the day, the purchasing power of your money is even, getting destroyed here if you're just owning an index.
Yeah.
So if he's right, maybe active investing and trading will become more popular in the next decade. Who knows? We don't know. But this is just a thesis.
Yeah, this has been a market. I think we've done a good job of at least telling people this for the last 6 to 8 months, preserve capital. I think we're getting to a market where if you wanted to take some chances, you start seeing some clear strength in biotech. But that's it.
So, as of right now, and as I said, these are such a tiny stocks that they can go down 20% in a day. Something happens in the market. So, but definitely, it seems like that when the markets bounce, it might be just another 20-30% bear market bounce. It seems like biotech is gonna outperform
100% gains.
And lead. So
certain energy as well.
Yeah.
Okay.
Sure.
All right, buddy. Have a great week. We'll be back next week, everybody. Hopefully this helps, and we'll share some of these names to keep an eye on.
Yeah, sure. All right. See you guys.